Good morning, everyone.
Good morning.
Most of you know who I am, but I'll just dispense with the formality. My name is Nick Rossi. I'm president of LP Insurance. We are a local independent agent, kind of expanding out into a regional footprint. And we specialize in construction coverage. We have a lot of our local contractors here today with us, so I thank you for attending this session. I have every confidence that it will be very, very informative. For those of you who are here for the first time, LP Insurance over the last couple of years has been putting on 2 to 3 times a year risk management seminars that cover a variety of topics. Today, we have one that's near and dear to all of us in the construction industry, and that is the construction defect environment, both in Nevada and in California, and the incredible explosion both in terms of frequency and severity within those claims. We have a panel of experts today, and I'm going to introduce, before I introduce the panel of experts, I'll introduce our risk manager, Matt Ennis, and Matt can introduce the panel. So, Matt, without further ado, the show is yours.
Thank you, Nick. Welcome, everyone. Back in January, we were setting out the schedule for our seminars this year. We talked about having the construction seminar in May because we thought that would be just before the weather started to get really nice and before our construction clients got busy. Obviously, the weather is nice, and we're excited that our construction clients are working and busy, but a lot of our clients have called in and said they wouldn't be able to attend today. But the good thing is we're going to have this on videotape, hopefully, and be able to post it onto our website. So for those of you that were able to arrange your schedule to make it, we're really excited. Like Nick said, we know that we're going to have some really good information coming from this seminar for you today. The first thing I want to do quickly is just introduce our risk management services team from LP. This is the group that provides value-added services to our clients, and I really think this is the group that really distinguishes our team and really helps our clients. Starting with our loss control experts, Lee Wilson and Rich Johnson. You guys want to just stand up real quick? Our work comp claims specialists, Kelly Woodward and Claudia Aguilar. And our property and casualty claims specialist, Danielle Hill. So if you haven't met these folks, you can put the faces with names, but we're certainly at your service and do whatever we can do to help you in those areas. About, I think it was in the early 1990s, I attended an International Risk Management Institute seminar, and been to quite a few since, along with a lot of our other LP team. And heard speak Jeff Masters, and to this moment, know how much Jeff really influenced me and really exposed me to some great risk management contexts and ideas and concepts in the construction and risk management area. And we're fortunate enough to have Jeff and his partner, John Musitano, here today to speak to us. Jeff is a partner in the litigation department and co-chair of the Development and Risk Management Practice Group at the law firm Cox Castle Nicholson in Los Angeles. He has deep expertise, and very deep expertise, in contractual risk transfer and insurance for major construction projects, and has served as insurance coverage counsel for owners in connection with the design, structuring, and implementation of more than 200 wrap-ups, both project-specific and rolling. Jeff represents owners, investors, developers, home builders, and lenders in complex insurance coverage, construction and real estate litigation matters. Jeff also has extensive experience structuring, implementing, and enforcing insurance and risk management legal programs for projects of all sizes. Jeff's a frequent lecturer and author for real estate and construction industry groups. Jeff's partner, John Musitano, is a partner in the Development Risk Management Practice Group. John resolves insurance coverage, real estate, and construction litigation disputes. He represents also owners, developers, contractors, and investors in both litigation and transactional matters involving complex and diverse exposures. John serves as pre-litigation and litigation counsel for both commercial and residential real estate companies, in addition to providing counsel to policyholders in coverage disputes involving construction liabilities, class actions, toxic torts, property and business interruption losses, and self-insured retention disputes, among others. John also provides transactional insurance and risk management advice, including structuring insurance, risk management, and risk transfer legal programs for his clients' real estate projects. John is also a frequent lecturer and author for real estate and construction industry groups, and serves as a member of the program committee for the Building Industry Association of Southern California. Obviously, we're very fortunate to have Jeff and John with us today, and look forward to hearing all they have to say, and look forward to a great seminar this morning. With that, I'll turn it over to Jeff.
Matt, thank you very much. And to all of you, thank you very much for taking time out of your busy schedules to be here this morning. We're really happy that we're in the beginning stages of what could be a pretty darn good real estate and construction recovery. As we look forward, though, we have to recognize that it's a time of both opportunity and risk. And what John and I and our colleagues at LP Insurance Services want to do this morning is offer you some really practical strategies for managing the construction risks that all of you face going forward. John and I are litigators by trade, but you'll find that a lot of what we do is preventing litigation. Sounds kind of paradoxical, doesn't it? We think we're doing our best work when we prevent or minimize the severity of construction litigation claims. We focus on the western states, California, Nevada, Arizona in particular, but we also work nationally for our clients. We're going to do our best this morning to be balanced. So to help us do that, let us get a sense of who's in our audience. How many trade contractors do we have this morning? Okay. How many general contractors? And how many owners and developers? Okay. Any design professionals? Seeing no hands, we're going to flow through all the risk to the design professionals. That's our number one tactic. In trying to be balanced, we're going to give you views that we've developed over the years that are primarily the views of the owners and the general contractors. But these are relevant to trade contractors as well. Because the old model of risk in our business, which is everything flows down to the trade contractors, has come under attack in recent years, particularly in the indemnity and the insurance areas. So we're looking at a universe that really is more collaborative than confrontational as it has been historically. And the use of wrap-up insurance programs on construction projects is an example of what we're going to call the new risk management environment. How many of you have been involved in a wrap-up insurance program, either owner-controlled or contractor-controlled? Yeah, a number of you. We're going to talk about and compare and contrast the conventional insurance model with the wrap-up insurance model along the way. So let's go to the next slide, please. What we're seeing is, as I say, the beginnings of what promises to be a really good real estate and construction recovery. But we think the environment has changed from the last upturn. We've got the continuing construction litigation threat, which is very acute in Nevada, Arizona, and California, and unfortunately becoming a western state's export to other parts of the country. We're also seeing liability insurers for owners, contractors, and trades take much more aggressive coverage positions when we tender the claims to the liability insurers. And we're going to talk in more detail about what some of those aggressive positions are and how do we respond to them. And finally, we're going to ask our valued colleagues at LP Insurance Services to talk a little bit about what we're calling a transitioning or firming insurance market. Worldwide, insurance moves in cycles like every other business. We are seeing the beginnings of some firming of insurance pricing, terms, and conditions. And it's important for all of us in this business to know how do we position ourselves to make the best submission possible to our insurers to get the best possible terms, conditions, and rates. Next slide, please. So here's one of our basic themes, and this we share with our colleagues at LP. We think that every player in the construction and real estate industries needs to implement what we've been calling comprehensive and integrated strategies to manage risk. It's not just your contracts. It's not just your insurance policies. It's a way of operationally implementing a risk management philosophy that takes you from the very beginning of the project through construction, all the way out the back end, through customer service and the end of the statute of repose. It needs to be integrated because each part of the risk management program should support the others. And as we'll see in a minute, when we implement an insurance program for a new project, we want to be sure that our contracts accurately reflect the insurance and maximize the insurance policy's values to us. That's what we mean by integration. So this morning, we're going to focus on two big topics. One is managing and insuring construction risks, broadly defined. And then we're going to spend quite a bit of time on what we refer to as building a better wrap-up program. For those of you in wrap-ups currently, or if you've been in them in the past, this may offer some real practical suggestions for how to improve the coverage you enjoy under the wrap-up. If you're new to wrap-ups, we hope this will be a good introduction to some of the complexities and the nuances of getting it right under a wrap-up program. Now that's a wind-up. I want to turn it over to John for a session on litigation risks, where they come from, how they develop, and what the legislative and practical responses have been.
So this is going to be a little bit of a touch on history. We're going to go through, excuse me, some of the fundamentals behind the risks faced by those in the construction industry, as well as the often changing factors affecting those risks. And there's a lot of factors that affect that risk, whether it be changes in the law, a changing economy, and a changing insurance market. These changes make it necessary for companies focused on risk management to continually assess and reassess the risks that they're facing, and then to assess the tools that they're using to combat that risk. To state something very obvious, this is important because of the significant costs that can be involved with the risks in construction. We know, especially in the residential context, claims to construction are significant and always a threat to profits, whether they be the prospect of large legal costs, costs to settle, the drain on company resources, not least of which is the drain on company time, and the potential injury to a company's reputation. All are significant. These costs we've seen have steadily risen over the years since the loose inception of this construction defect cases as an industry. Booming CD claims led to, as you'd expect, growing losses for insurers, and then the expected counter-reaction by insurers to reduce coverage, increase premiums. The logical next step is builders, contractors seeing higher risk. The building industry reaction, at least in part, included pushes eventually across the states to limit homeowners' plaintiffs' ability to simply walk into court and sue. This mainly came in the form of right to repair statutes, and not surprisingly, many of them included significant concessions to the plaintiff bar. In Nevada, we're talking about Chapter 40. And like other statutes, Chapter 40 involves a lot of detail, but really two main parts. One, a statutory definition of what constitutes an actionable defect. There's also the other portion of it which sets forth the pre-litigation procedures that a plaintiff has to file prior to just filing a lawsuit. In California, we have SB 800, which is, again, similar in context. We have what we refer to as Chapter 2 of that statute, which is a laundry list of functionality standards, generally separated by trade, defining what a defect is. We get to some of the problems with some of these statutes, but in California, we struggle with that alone. Some of those functionality standards mention damage, some don't. You can get a little detail later about some of the difficulties that brings on the insurance side. SB 800's other side is referred to as Chapter 4. And in California, that's an optional pre-litigation process. Developers, during development, time of sale, decide whether or not they're going to opt in or opt out to that process. If they opt in, they record that election on title, they give notice to homeowners. And when there's a claim, homeowners have to follow this process, like in Chapter 40 of giving the builder notice and an opportunity to repair. With both statutes, as everybody in the industry knows, there's been some minor and some significant criticisms. The purpose behind these had a couple sides to it. One, the consumer side to protect homeowners, give them an avenue of recovery, and for builders and others involved in the construction industry was to give them an opportunity to avoid litigation. But frequently we hear in both states complaints about which have opted out, and a lot of it we've seen comes down to these details about the pros and cons. For some of our public builder clients who have the resources, the staff to be able to jump on these claims, we've seen a lot of them opt into this process. With private builders, we decided to basically contractually set forth procedures they'd like a homeowner to file, give themselves a little bit more freedom, but the results of all this are still out for California. In Nevada, Chapter 40 has been around a little bit longer, and I don't know if any of you have seen several professional reports have come out about Chapter 40, including one earlier this year from UNLV. I'm sure there's others like it. They commented about the need to take a really hard look at Chapter 40. They referenced the fact that between 2000 and 2012, the period of new home sales decreased approximately 86%. CD claims rose 355%. Since 2006, claims per new home were at least 38 times the national average. So, issues. It's not surprising that 2013 has seen a lot of activity, an uptick in legislative activity to try to rework Chapter 40. I'm not going to get into that today, but happy to talk about that with anybody after the session. Some of those efforts, sounds like they've already died for now. Others are still active, and I heard this morning that some are being discussed even today. These would be a reworking of Chapter 40, attempts to eliminate the attorney's fees right for plaintiffs, even proposals to reduce the statute of repose, the statute of limitations, how long the plaintiff has to sue. So we will watch that closely. So adding to this, the industry getting used to these statutes and how best to work with them, parties are also adjusting to significant change on another front, which is the indemnification front. Historically, both for residential and commercial projects, owners, GCs, are used to using indemnity to pass liability downstream. This involves the duty to indemnify, a duty to defend. It has traditionally extended even to the indemnities, GCs, own role in those claims. But recent trends have seen an erosion of this risk transfer, both in new statutes and in case law. On the anti-indemnity statute front, I'm not aware of one yet in Nevada, but in the last 5 or so years in California, we've seen new statutes both in residential, first in residential with AB 2738, which limited the indemnity that a builder could get in construction defect context to that arising out of the subcontractor's scope, an equitable share. It also set forth some defined procedures on how the duty to defend would operate. Under that statute now, subcontractors have the option of either assuming the defense for the upstream partners or paying a pro rata share. It's worth noting that also tacked onto that statute was a requirement that where there's a RAP policy, specific disclosures, contractual disclosures are required to be provided to the subs. We'll get into that a little bit later. And also a limitation on indemnity. Where there is a RAP policy, indemnification is limited to the extent covered by that RAP. This year, we saw that extended a bit to the commercial context with similar restrictions on the level of indemnity that can be provided from subs. Indemnity has also been affected by case law, and the statutes I just mentioned in California were preceded by a significant decision, which in this case happened to be on the developer side. I'm not going to go into detail. The case is Crawford versus Weathershield, and in a nutshell, the California Supreme Court set out that where a subcontractor is contractually obligated under an indemnification agreement to a general contractor, the duty to defend was automatic and immediate. The subcontractor, by way of indemnity, had an immediate obligation to defend that contractor at the inception, even prior to a determination of fault. That led, especially for contracts entered into before the statute I mentioned, a more aggressive pursuit of subs to pay defense under indemnity agreements. In Nevada, there's been a shift as well, especially based on a couple recent decisions, the George Brown insurance case in 2010 and the Rayburn Lawn case in 2011. Prior to that, Nevada companies traditionally enjoyed great freedom in allocating risk. Indemnity agreements basically covered loss arising from that sub's work, but the new cases require more explicit language if a developer or general contractor is going to be indemnified for their own negligence. The George Brown case, the Nevada Supreme Court adopted the rule that while parties were free to indemnify another for their own negligence, the contract language had to expressly reflect that intention. In the Rayburn case, more specific to the construction context, the Supreme Court held that absent express language regarding the sub's duty to indemnify a GC as an example, for that GC's contributory negligence as well as their sole negligence. Without that, there will need to be negligence proven on the part of that sub in order to trigger the indemnification, and if that's done, the indemnity will only cover damages arising from the sub's negligence. This is still evolving. The upshot seems to be that more explicit language will be required, but it remains to be seen exactly what language will accomplish this. So obviously we're left with a changing landscape, some uncertainty. We talked about statutes and uncertainty on the indemnification front. Some clients are seeing some of this, and on that alone express an increased interest in not having to deal with indemnity as much and pursuing RAP. Aside from the legal changes, the high losses that we've seen brought its own response from the insurance industry.
Thanks, John. Well, I want to talk for just a minute about how the insurance industry, from our perspective, has responded to this. Well, predictably, not well. They're incurring tremendous losses from construction defect litigation in Nevada, the other western states, and states across the country. Construction has always been a tough class of business to insure for many good reasons. There are a lot of bodily injury hazards, job site injuries, and so forth. Historically, that was a driver for making it a difficult class of business to insure. Construction defect litigation has certainly added to that because it makes it very difficult for the insurance underwriter to price her product properly, not knowing what the anticipated losses are going to be. And so in response to the landscape that John described, what are we seeing from insurers? Well, a couple of things. One, there's been a real change in the lineup of insurers willing to even write the business in which we're engaged. As coverage lawyers for our clients, we're always seeing new players who are entering the market who want to write construction wrap-ups, either for new construction or for condominium conversions. And you ask yourself, why is that? Well, the underwriter for NewCo, the new insurer, starts with a clean slate. She can collect premium, the losses won't mature for a number of years, and they get the benefit of the float. In a low interest rate environment, one wonders how effective that business model is going to be, but that's what it is at the moment. So we see a changing cast of characters among the insurers willing to write owners, contractors, and trade contractors. We also see a departure from the market of more what I'll call conventional mainline insurers. AIG, formerly known as Chartis, as you all know, used to be a very significant player in the construction insurance space, both for trade contractors, contractors, and owners. AIG made the business decision late last year to simply not write in certain states any more residential business. California is one of them. Nevada is probably on the short list to be among those states as well. Why? Severity and frequency of losses due to construction defects. Zurich had its Home Builders Protective Program, HBP, for almost 10 years. Losses began to develop. The losses became so significant, and the economics of the program during the real estate downturn became so adverse that Zurich, too, completely exited the residential construction insurance market under the HBP program. They still write contractors and trade contractors, but under conventional policies, not wrap-ups so much. So we see this interesting changing lineup of potential insurers. That creates uncertainty for all of us in the business, both insureds and the professionals who serve them. A new insurer who is unknown to us, we don't have any history with them from a claims handling perspective. Will they be good on claims handling? Will they be difficult? We don't know yet. And as you know, underwriting rarely talks to the claims department. Once a claim is made, you hope that the underwriting intent gets followed through and the claim gets handled appropriately. But it certainly doesn't always happen. The other thing we're starting to see is some difficulty getting pricing that's competitive. And we're seeing it, and I'll be very interested in LP's reaction, we're seeing it first on the excess layers. For example, you probably have a layered insurance program at your company. You have a primary layer, an excess layer, maybe an umbrella, and depending upon the size of your business, you may have a couple of layers of excess coverage. We're seeing in the first and second excess layers right now a very strong firming in pricing, which is making some of this coverage less affordable and less economic for the clients. We see this both in conventional insurance programs and also in wrap-ups. The other place we're starting to see some pushback from the insurers is on terms and conditions, the actual words in the policy and the endorsements. Some insurers are adding more aggressive exclusions for prior loss, prior defects, prior damages. So effectively what you're buying, if you buy a conventional annual renewal policy for your company, you're buying a very limited window of coverage that will not apply to prior loss or damage, whether it's known or unknown in some cases, only to loss or damage that happens during that year. That leads to an interesting allocation issue. What if you're sued in a construction defect lawsuit and the damage spans multiple years? Well, the current policy with that exclusionary wording won't apply to all the damage prior and all the damage following. You will then have a patchwork of different insurance policies potentially responding to the same construction defect claim. What does that mean from a practical perspective? More frictional costs, more management time for the insured. They have to manage their insurance estate in a much more acute way than they did before. So if this is If this is adding up to anything, in our mind, it's adding up to a need for a lot of attention when you place new insurance for your projects or your company, whether conventional or wrap-up. It's just a much more difficult game. John, talk for a minute, if you would, about the litigation threat, what some of the drivers are that's pushing the insurers in this direction.
Well, obviously the litigation threat continues, and with respect to construction, continues to be a driving emphasis on companies' risk management. We see continue to paint a picture of the challenges that face developers and contractors of all levels. Talked a little bit about legislative changes, the adjusting insurance markets, but clearly, the litigation threat continues. Some say it's a fact of the business. It certainly comes in different forms with different drivers that can also change over time. One of the more significant drivers we've seen affecting this is certainly not an exclusive list. One being what we call homeowner susceptibility to suits. Talk with our clients now almost a decade ago about things that they could reinforce to their homeowners as they attempted to stay close to their homeowners. The fact that the builder was around to assist, and that really, construction defect for the homeowner had a big negative of damaging the equity of their homes potentially. With the residential boom and the downturn, homeowners saw a loss of market value, loss in equity, and homeowners really factored in being less incentive to protect that equity, more susceptible to plaintiff attorneys, therefore more susceptible to joint suits. At the same time, that important contact that I just referenced, developers trying to stay close to their homeowners, a good relationship, maybe have will result in the homeowners calling them first and not a plaintiff attorney. Some factors came together to result in developers really losing a lot of that close contact. One, foreclosures, obviously no more homeowner, and new buyers, subsequent owners moving in with no contact to the builder. And also, a lot of builders had significant reductions in size during the downturn. Didn't have the staff to respond. So aside from homeowner susceptibility, we know that a constant are opportunistic plaintiff attorneys looking for that track that hasn't been targeted yet, looking for the problem issues, searching for new claim types. We've seen more and more, this is including looking for kind of the one product suits, product failures, Chinese drywall, pipe issues. Easy for a plaintiff attorney to convert that into a class action in contrast to a variety of claims that come up in a normal CD case.
And John, if I could jump in for a second, extending your thought there about product failures like Chinese drywall, Chinese pipe, we're also seeing a trend among plaintiff lawyers to look for what we're going to call system failures in the home, as opposed to traditional CD claims, which usually involve poor workmanship or allegations of poor work. Now we're seeing plaintiffs getting away from the poor workmanship claim and going instead to a claim of failure of a system in the home. For example, HVAC, air balancing in the home, tight building syndrome, that's a shorthand for alleged health concerns inside the home, because for energy efficiency, it's very tight. You can't get as much external ventilation. We're also seeing other systems in the home, like pre-manufactured trusses, things of that nature. So the practical impact is, as John says, if you've got a consistent systems failure within all the homes, it's easy for the plaintiff lawyer to sign up a few homeowners and get a class action started. The economics of a class action for a plaintiff are really good. They're going to have a big payday. The homeowners will get a minimal payout at the end, but of course the plaintiff lawyer never discloses that to the homeowners. From a purchasing standpoint, what does that mean? It means that we have to be really careful when we buy any pre-manufactured products or systems to use a full-blown subcontract agreement as opposed to buying them like we used to buy materials, sometimes with a purchase order. We want to be sure we have the full range of risk management, indemnity insurance protection from that supplier that we would have from one of our trade contractors. And that's a change that's been dictated by a lot of our clients getting burned, having inadequate contractual risk transfer with people who supply a significant component of the home.
So what are the forms of exposures making up this litigation threat? Well, Jeff just discussed some of them. You know, obviously, it come in the form of construction defect suits, which can be fairly consistent. We still see, in terms of the most prevalent, some of the same issues focused on water, moisture intrusion, soils, foundation, roofing issues, as well as the product failures we just talked about. But more and more, we're seeing companion claims in these suits of fraud, breach of fiduciary duty, including allegations that the developer made insufficient disclosures or allegations that the association budgets for those with HOAs were insufficient. This has unfortunately been exacerbated on the insurance side the last few years on the claim handling side, at least from what we're seeing. Some of our clients are seeing some fairly aggressive denials and claim tactics by some insurers. Whether this is a factor of the losses that insurers face, both in the downturn, their inability to make money on the reserves, or the fact that some of these carriers have exited certain markets, regardless of the cause, it's an increasing factor we're seeing. Also, some ramping up in early declaratory relief actions filed by insurers. So over here we have a construction defect as an example, a lawsuit going on, and then out pops in federal court that insurer, which is paying to defend you, filing a suit against the developer or another party saying, we think we either have no coverage for the suit or significant areas that shouldn't be covered. Definitely a ramping up on that. We're involved in some of those on several fronts. Again, this is the insurer being plaintiff. Bottom line is, talk with our clients, insurers really can't expect a status quo on the claim side. These continuing exposures make it critical for all companies to find the best insurance solution that fits that company. So on that front, we're going to shift to a discussion about our current insurance market. Jeff, do you want to say what it is?
Yeah, let me transition this. We call on the expertise of our colleagues at LP Insurance Services because they are the experts in this. We talked earlier about this idea of a firming or transitioning insurance market that would affect you as buyers with higher prices, higher premiums, more difficult terms and conditions. So we're asking the broad questions, are we really in a harder market? And if so, why now? What does it mean from a practical perspective to the insurance consumer?
And I guess that's directed towards me. I don't have a mic on, so hopefully everybody can hear me. I don't know that we're necessarily in what I would call the old traditional hard market where pricing drives up so significantly that basically you got to take what you get. I think more so from the perspective, and I like the transitional market comments, we're seeing maybe not the pricing issue as much as the product issue tightening. So exclusions, compressing of the marketplace on who we have availability for. I think that's a little more of the hardening or transitioning of the market versus the pure common, what used to be, just price driving up as considered or defined in a traditional hard market. That's what we're seeing. And Nick, I don't know if you want to add anything to that. But at this point in time,
You're going to bring me up into the panel?
no. I think at this point in time, that's what the market is trending towards. if you look over in California, and if any of you have workers' comp over there, I would say that's a hardening market there from a pricing standpoint. But from the construction side here on the Nevada side, I think we're more in a transitional phase, and I think the hardening, if you're going to call it that, is truly in the product itself and the market availability for what we have.
I agree. I think I agree with what Mike's saying. I think Jeff and John were right on it when they said, we're seeing a lot more aggressive denials. We're seeing a lot more challenges on the coverage side, which it's not affect necessarily like the bottom line number that you're seeing is going up, but you're seeing just the challenge of getting coverage from your insurers that you didn't see in the past. And like John said, don't expect the status quo. Don't expect what we saw in the past. You're going to get challenges. They're seeing it at the litigation level with early declaratory relief actions, like John said. We're having a fight on claims today that we didn't have to fight so much on in years past. And Nick and I have been right in the middle of challenges with insurance companies that are trying to allocate the claim back to a policy year or to more current policy year that's a construction defect claim that traditionally has been assigned to an older policy. So what's the practical effect for you? You're seeing that claim that was from work you did 5 or 6 years ago showing up on as a 2011 to 2012 policy year loss. So when our team goes out to market for you, instead of knowing that claim happened 5 years ago and it's not going to be on a 5-year loss run, it's still sitting there, or it is sitting there, and it's going to affect the insurance underwriter's consideration of your risk when it's from work you did, again, 6 or 7 years ago. It might not even be work you're doing anymore. But nonetheless, it's affecting our ability to remarket your insurance. So in that sense, it is a harder market, a higher premium issue that we have to consider for you.
Matt and Mike raised some great issues there from a practical business perspective for all of you. It really means that in placing insurance, your annual renewal or a new wrap-up for a new project, if you're the sponsor, owner, or general contractor, you really, really have to work with the broker and with your coverage counsel to make your submission to the insurer as persuasive as you possibly can. The days of being able to submit an application with some supporting documentation are long gone for us in the construction industry. Our view is that the submission has to really tell your company's risk management story so the underwriter understands why your company is a better risk for them to cover than the other people who are submitting applications. And that risk management story, in some cases, depending on the size of your company, could include details about your overall risk management program, loss control, safety, risk transfer by indemnity and insurance requirements to other parties. And that sets the tone for the underwriter's review of your financial information and your loss runs so that she's looking at it with a mindset of, this is a superior risk for me to be writing. We've collaborated with our broker colleagues on a lot of submissions to try to craft that kind of a risk management story. And it's helped a lot to get better quality coverage at better premiums in a market that's transitioning. And just to add to Matt's point, this issue about loss runs is really important. LP will ask you for 5 years or maybe even 10 years of loss runs. When you get the loss runs, what LP will do is help you explain what's on there. For example, if you were to take a slightly higher deductible or self-insured retention on your next policy, that would allow LP to better classify the losses by saying, yeah, we had some frequent small claims, but under the new proposed deductible, those would never even have been reported. They would have been self-insured by the company. Likewise, this issue about placing old construction defect losses under more recent policies is really troublesome. We've wrestled with this too. And the best approach we've been able to come up with is to work with your broker to try to find some evidence that we can have the broker give the insurer to say, wait a minute, don't place that loss in our 2010 policy year, place it somewhere earlier. For example, in one situation, in a continuing damage construction defect suit, we were able to demonstrate to the insurer that the property damage first got noticed, it first was discovered by somebody way back in 2003, and it continued allegedly over time. The lawsuit was resolved in a later policy year. Well, at a minimum, that means you don't put the whole loss in the 2010 policy year. Maybe you put some portion of it, 20% each of 5 years, to reduce the hit to your loss run. So there are some creative ways that you can approach this to make the loss run better explainable to the insurer. And again, we acknowledge it takes management time, it takes some focus, but ultimately it pays off. We've been going for a while, and I wanted to ask if anybody has questions on anything we've covered so far.
I was negligent myself when I made the introductions. I didn't introduce Mike Talbot, who's up here on the panel. I think everybody knows Mike, but he's a principal within our office. And as the session goes on, both John DeRico and Nick Rossi will be up here too. So it's fun to meet you.
A couple other things regarding what Jeff has indicated. A lot of the things he's indicating, it comes back to us to work on your behalf and to drive that submission. A couple things that we're focusing on this year that we're hearing from underwriting, whether it's your practice policy or a RAP, is looking at financial statements. That can drive an underwriter to take a more favorable look in the marketplace. As Jeff indicated, OSHA compliance, your loss control. When we can package that all up and paint a better picture, that's going to have more success in the marketplace. But I think financial statements are going to be drilled down to a little bit more from the underwriting perspective these days, particularly when we start to look at things like the deductible situation, where we might have eliminated claims.
Matt, any other comments on improving the risk profile of a company?
I think you mentioned, Jeff, talking about bragging, if you will, about Fair General, for example, strong indemnification provisions in your subcontract. Good, just really showing the underwriter that you have a very good focus on risk management in your operations. You've maximized the subcontract to get as many risk transfers as possible that are reasonable to shift amongst your contracting partners, to, as Mike said, show your financial strength if you're considering a higher deductible or higher self-insured retention. If you need to, and if you have some significant claims in your loss experience, take the time to come up with a paragraph or two, which we will help you do, to explain the losses and to explain the steps that you've taken to prevent the losses from happening again. That can give the underwriters some reassurance that you're a good risk, that you're not just disregarding losses that have happened. You're trying to take proactive steps to manage your risks as the best way you can. Anything like that is going to be something that benefits you in the long run. And really taking the time to work with us and help us put together the best marketing submission possible, that will pay dividends.
Some other proactive strategies that all of us on this panel have been thinking about, and that's to take a fresh look at the different liability insurance alternatives that are available to your company. A lot of you are in a conventional annual renewal program, which means that you go to market each year to buy your liability insurance and other lines of coverage. And that is a very defensible strategy. It's essential for trade contractors because 100% of the trade contractor's work is not going to be covered by wrap-ups. And even if it is, a number of the trade contractors with whom we're familiar continue to buy their conventional annual renewal program for their own balance sheet protection. It's very prudent to do that. A lot of our general contractor and owner clients are moving predominantly toward the wrap-up model, but they too will maintain a conventional annual renewal program because not 100% of their output is covered by wrap-ups, and they have other lines of coverage that they need to maintain for their protection. Project-specific and rolling wrap-ups. The concept of a rolling wrap-up is one that covers more than one project. Production home builders, public home builders, for example, frequently have a corporate rolling wrap-up program that they put all of their output into for the term of the wrap-up. You can also do a mini rolling wrap-up, which is for a portfolio of projects. Or you can do a single project wrap-up, either an OSIP, owner control, or a CSIP, contractor control. These have got a lot of advantages for the sponsor, and I'm going to submit advantages for the enrolled parties as well, the enrolled parties being the contractor and the trade contractors in the OSIP scenario. There's also a product called Owner's Interest Policy, the Owner's Interest Policy. Now, what is that? This is a liability policy that protects the interest only of the project owner. Where would you use this? If you're an owner or a developer and you're relying on the general contractor's insurance for a particular project, let's say you're building an apartment project. You, the owner, rely on the general contractor and the trade contractor's conventional liability insurance, annually renewed with certificates and additional insured endorsements, the usual drill. But you're worried about the adequacy of the limits of the other party's insurance. You can buy an owner's interest policy that protects only you, the owner, and applies excess of the other party's insurance. We see this a lot on condominium conversion projects and rehab projects in the residential space. And when those projects become more predominant in Nevada, I predict you will see the structure as well. It's a good option for the owner and relatively cost effective. There are other insurance programs that are more for the new home construction part of our industry. We mentioned earlier the Zurich HBP program. That was a special liability product for builders, home builders, who wanted to provide a more comprehensive insurance product that would cover not just bodily injury and property damage, but also their customer service and warranty obligations to the homeowners. Zurich pioneered this concept, priced it in a way they thought was appropriate. A lot of production home builders bought this product. With Zurich exiting that market, we're happy to report that there are two options now available if you want to continue with that kind of a model of insurance and warranty coverage. One is a program written by Arch Specialty Insurance Company, and it's called CRU, Construction Risk Underwriters. And ask one of your LP representatives about it if you have questions. It's good as an option for a production home builder who wants to have that HBP type coverage in place. There's a more recent option that does something very similar by a company called Cove, C-O-V-E, Cove Programs. Similar to the Zurich HBP, it's got some advantages in terms of how the self-insured retentions apply. We also commend that to your consideration if you're in the production new home building business. And then condo conversion wrap-ups. I know condo conversions are not back yet in Nevada. We are starting to see them in other states where the real estate recovery is perhaps further along in the cycle. But just keep this in mind when they do return to the Nevada market. If you get into the condominium conversion business as the converter, you're going to have a couple of worries. One is, as the converter, I'm buying an existing structure that I didn't build. I have no idea what the construction quality was beyond what my diligence in the purchase might tell me. How do I hedge that risk? The other concern the condominium converter has is, well, because I don't know that much about the prior construction, I got to be sure I've got liability insurance if a claim arises out of that prior construction. But if the converter buys an off-the-shelf wrap-up policy and doesn't modify it significantly, the converter's probably not going to have the right answer to either of those questions. The converter needs to be sure that the new wrap-up policy that he or she buys gives coverage for the prior work. That prior work is not the work of the converter. So you have to modify the policy words to be sure that prior work is covered. You also have to be sure that you're not going to get aced out of coverage later if the policy includes one of those pre-existing injury or damage or defect exclusions. We'll talk more about that in a few minutes.